Nice to have you with us this morning. Let's kick off the hour with a deeper conversation on the stock market's big return. In the case of the TSX, surging more than 1,100 points last week. Philip Petursson is chief investment strategist at IG Wealth Management, and he joins us here in studio. We mentioned, Philip, that the U.S. futures pointed to some possible continued gains today. Would you be surprised to see that?
No, I wouldn't. Think about what happened last week. We had 5 up days in a row. Now, put that in context of almost the last 100 years, that only happens about 4% of the time. So when this happens, you tend to see markets continue to drive positively over the course of the next year. So this is a change in consumer or investor sentiment. This is a change in some of the technicals in the market that I think can lead to further upside through the end of the year. A
lot of people have pointed to different considerations, central bank talk being one of them for the change in the mood of the markets. What's been your assessment? Why are investors in a different mood now?
Well, I think it's a combination of a number of different things. One, yes, I think that the Federal Reserve, while they haven't explicitly signaled it, the market is taking it as a pause, that we've seen the end of the rate hikes. Maybe there's one more, but we would need to see some pretty sharp inflation data to spook the Fed into another rate increase, but I think they're largely done. Then you had some of the weaker economic data that we had last week. Not bad, but the PMI was weaker. The jobs data was a little bit weaker than expected. And that doesn't mean that it's a clear sign the U.S. economy is headed to recession. It does mean, though, that we're seeing softness in the economy that the Fed should take as a sign that inflation will continue to trend lower, and that's good for valuations.
And how is this going to affect money flows, I guess, in the short term? Because a lot of people were looking at, for example, yields in the bond market. There's another story there, which is higher yields maybe make the borrowing situation a little tighter, and that also had spooked some equity investors. But a lot of volatility in fixed income, maybe more so than the average investor would like.
Well, exactly. We've seen the 10-year U.S. Treasury yield go up almost to 5%. I think it hit 5% at one point intraday, and now it's back down to about 4.50 and change. And that, if you look at it, that is quite a bit of volatility in the last month. It has whipsawed fixed income investors, but here, too, we think that we are near the peak of the interest rate cycle. And if you look out a year, 2 years, 3 years, bond returns look much more attractive from where we've come over the last 2.
Let's stay with that theme of where we are in the cycle, both with monetary policy and just with the economy overall. Because on the one hand, you're getting into something that it seems like investors have been waiting for. There's a lot of historical evidence when you come to an end of a rate hiking cycle, that's generally a good thing for equities. But a lot of people are wondering where the economy lands, particularly in this country. Already there's a lot of growing concerns about a recessionary environment. Is that good for stocks?
Well, it really depends where you're standing. If you're standing in Canada, I think Canada is clearly in a recession right now. That doesn't necessarily mean bad news for the TSX. It could be headwinds for some of the sectors in Canada, consumer discretionary, for example. If you think of the large retailers in this country, they could be suffering headwinds as a result of the overall economic weakness. But largely, our index is globally driven. And if we're seeing stages of a recovery globally, that's good for the TSX.
And so when you think about sector breakdown, because we often like to do that little portfolio construction, you've shared your thoughts over the last few months. What's it looking like right now?
Well, if we look at the TSX in particular, I think the banks are still attractively valued. I think that they could see some bumps over the near term, but again, thinking longer term, where valuation is and where the dividends sit and the prospect for those dividends to go higher, the financial sector is really attractive. I think energy is a little bit trickier to navigate. We are leaning a little bit more pro-energy over the course of the next 12 months, but with what's happening in the Middle East, that can be thrown one way or the other very, very quickly. So it's not as clear in Canada. It is clear geographically where we're seeing opportunities in Europe. We're seeing some opportunities actually emerge in the United States, as well as Canada.
Do you think Canada is done with hiking interest rates at this point?
Yes, last time I was on, I think I said I'm 99% certain. You have to leave a little window for the error there. I would say now I'm 99.5% certain that the Bank of Canada is done. There's plenty of evidence to suggest that they can pause here comfortably, that inflation will continue to trend lower.
And I guess the moves into 2024 would depend on where the economy is, where the inflation story sits, because we've heard from people who think it'll be a slow process towards the idea of possibly cutting rates. And we've heard from other people who think by the end of next year we will have seen a sizable change in rate policy in this country.
Yeah, and I'm somewhere in between.
Okay.
I think that the Bank of Canada isn't in a hurry to cut interest rates, and they've indicated that they do want to know with certainty as best as we can that inflation is headed towards their target of 2% plus or minus 1. So I think that the bar to cut is very high, and I'm of the mind that the first cut is probably in the latter part of 2024.
Okay.